Welcome back to another Wealth Code video, guys. Like, subscribe and comment if you want to see more of our great videos. What if I told you that taxes could silently steal up to a third of your investment gains, and most people just let it happen? You work hard to invest. You pick great stocks or funds. Your portfolio grows. But then April comes, and Uncle Sam takes a massive bite. Here's the thing. Wealthy investors don't earn more just because they pick better investments. They build portfolios designed to keep more of what they earn. That's called tax efficiency. And today, I'm going to show you exactly how to build a tax-efficient investment portfolio from scratch, even if you've never thought about taxes and investing together before. Think of it this way. You wouldn't leave your front door wide open in winter and just crank the heat. So why let taxes drain your returns when there are perfectly legal ways to stop it? First, you need to understand the 3 tax buckets. Think of them like 3 different types of containers for your money. Bucket 1 is taxable accounts, your regular brokerage account. You pay taxes every year on dividends and gains. Bucket 2 is tax-deferred accounts, like a traditional 401k or IRA. Your money grows without taxes now, but you pay taxes when you withdraw later. Bucket 3 is tax-free accounts, like a Roth IRA or Roth 401k. You pay taxes on money going in, but everything comes out tax-free in retirement. The key insight is this. Wealthy investors don't just pick one bucket, they use all 3 strategically. Each bucket has different rules, and by spreading your investments across them, you control when and how much tax you pay. That flexibility is incredibly powerful. Most people throw all their investments into one account and never think about where each investment actually lives. But here's the thing, placement matters enormously. Think of it like packing a suitcase. You wouldn't shove wet shoes on top of clean clothes. You separate things strategically. Tax portfolio efficiency works the same way. Investments that generate heavy taxes, like bonds paying regular interest or funds that kick off lots of dividends, those belong inside tax-sheltered accounts like your 401k or IRA. Why? Because you won't owe taxes on that income each year. Meanwhile, investments that grow quietly without producing much taxable income, like index stock funds you plan to hold for decades, those can sit comfortably in your regular taxable brokerage account. They're already tax efficient. This simple strategy of matching each investment to the right account type is called asset location. Not asset allocation, asset location. And most people completely ignore it. So here's your simple framework. Step 1. Identify your tax-heavy investments. Bonds, REITs, actively managed funds that trade frequently. These create taxable events constantly. Put them inside your retirement accounts where that tax bill disappears or gets deferred. Step 2. Place your tax-light investments like broad index funds and stocks you'll hold long-term into your regular taxable account. They naturally generate fewer taxes, and when you eventually sell, you'll pay the lower long-term capital gains rate. Step 3. Rebalance from within your retirement accounts whenever possible, because buying and selling there triggers 0 tax consequences. This isn't about picking better investments, it's about putting the same investments in smarter locations. Studies show proper asset location can add up to 0.5% of extra annual return, and over decades, that compounds into serious wealth. Now here's where it gets clever. Asset location. This is different from asset allocation. Asset allocation is what you invest in. Asset location is where you put each investment. Imagine you own a loud dog and a quiet cat. You'd put the loud dog in the soundproof room, right? Same logic. Investments that generate lots of taxable income, like bonds and REITs, are your loud dogs. Put them inside tax-deferred or tax-free accounts where that noise doesn't cost you. Investments that are naturally quiet, like index funds that rarely distribute capital gains, can sit comfortably in your taxable account. Simply moving the same investments into the right accounts can save you thousands of dollars annually without changing your overall strategy at all. Same portfolio, same risk, less taxes. That's free money. Here's a simple rule. Index funds are almost always more tax efficient than actively managed funds. Why? Because active fund managers constantly buy and sell stocks inside the fund, generating capital gains that get passed to you, the investor. You owe taxes on gains you didn't even choose to make. Index funds, on the other hand, just track a market index. They rarely sell holdings, which means fewer taxable events. It's like a kitchen that barely creates dirty dishes versus one that uses every pot and pan. Both make dinner, but one leaves a much smaller mess. Choosing low turnover index funds or ETFs for your taxable accounts is one of the easiest tax efficiency wins available to any investor at any level. Tax loss harvesting sounds complicated, but it's actually simple. When an investment in your taxable account drops in value, you sell it at a loss. That realized loss offsets gains you've made elsewhere, reducing your tax bill. Then you immediately buy a similar, but not identical, investment to stay invested. It's like trading a dented car for the same model in a different color. You keep driving, but you got a tax discount. You can offset up to $3,000 of ordinary income per year with excess losses, and carry unused losses forward indefinitely. Many robo-advisors now do this automatically. It's one of the most overlooked strategies for everyday investors. You're literally turning temporary paper losses into permanent tax savings. This sounds obvious, but most people don't actually do it. Max out your tax-advantaged accounts before investing heavily in taxable ones. In 2024, you can contribute $23,000 to a 401k, $7,000 to an IRA, and $4,150 to an HSA. An HSA is actually a secret weapon. It's the only triple tax-advantaged account. Tax deduction going in, tax-free growth, and tax-free withdrawals for medical expenses. If your employer offers a 401k match, that's free money. Grab every dollar of it first. Then fund a Roth IRA if you're eligible. Then consider your HSA. Only after maximizing these should you pour money into taxable brokerage accounts. This order alone can save you hundreds of thousands over a career. The tax code rewards patience. If you hold an investment for more than 1 year before selling, you pay long-term capital gains tax, which maxes out at 20%. Sell before 1 year, and you pay short-term capital gains taxed as ordinary income, up to 37%. That's nearly double the tax rate just for being impatient. Think of it like aging cheese. Sell it fresh, and it's ordinary. Wait a year, and it's worth significantly more to you after taxes. This is why frequent trading destroys tax efficiency. Every time you buy and sell quickly, you're volunteering to pay higher taxes. Build a portfolio you're comfortable holding for years. Patience isn't just a virtue in investing, it's a tax strategy. Let's bring it all together. Step 1. Use all 3 tax buckets. Step 2. Place tax-heavy investments in sheltered accounts. Step 3. Choose index funds for taxable accounts. Step 4. Harvest losses when they appear. Step 5. Max out tax-advantaged accounts in the right order. Step 6. Hold investments longer than 1 year. You don't need to be rich to do this. You just need a system. Building a tax-efficient portfolio is like insulating your house. The savings compound quietly every single year. If this video helped you see investing differently, hit subscribe and turn on notifications. Wealth Code drops new videos every week to help you build real, lasting wealth. Start applying just one of these strategies today. Your future self will thank you. For more videos from Wealth Code, don't forget to like and subscribe.